Hi, I'm Linda Eedes. This is an update on the RECM Equity Fund. That is, of course, our local equity fund, which is benchmarked against the JSE All-Share Index. So I'm going to talk about the last quarter of the year, but I'm also going to recap the whole year as a whole. And if you look at the quarter, it was really a continuation of what we saw for the entire year, which is that the market was down. It was down almost 5% during the last quarter of the year. The RECM Equity Fund was actually up 2.3%. So it really sort of bucked the trend. And that's been the case for the entire year. If you actually look at the market over the year, it was down 9.5%. The RECM Equity Fund was one of the very few local equity funds which actually posted a positive return. Just positive, it was 0.5% after fees, but nonetheless, I think in comparison to many funds out there, I think that's a pretty good result. And if you've been with RECM or been following RECM for a number of years, you'll probably know that part of our philosophy and style is to try to hold our ground when the rest of the market is down, and to really sort of stack the odds in our favor by buying undervalued stocks such that the price is down. Hopefully that protects us against further downside, but you've got a lot of upside potential still. So in actual fact, this fund, I'm very pleased to say, is the top performing South African equity fund over the last 3 years. So the top performing actively managed South African equity fund available to South African investors, benchmarked against the All-Share Index, and it returned 13.4% per year over the last 3 years. And if you compare that against the All-Share Index, which is 4.3% per annum, you can see that we've quite strongly outperformed the market. And I think that this is very important because one of the benefits of having a value manager as part of your overall portfolio is that we tend to do well when the market isn't doing so well, and when, as a result, any manager who's positioned more closely to the market is probably not doing so well either. So in some ways, you can say that your value portfolio is your insurance against the rest of the market not doing so well. And that certainly has been the case over the last 3 years. So if we look a little bit, sort of narrowing it down to more recent times, if we look over the last year and sort of unpack how the fund managed to deliver a positive return when the rest of the market was down, a lot of that has got to do with the fact that for quite some time we've been moving away from a lot of the stocks which had a very, very strong bull run, which we felt were overvalued as a result, and which we held very little of or none of in our portfolios. Conversely, for some time we've been sort of scratching around in a lot of the small and mid caps, trying to find those businesses which have probably been through a very tough time already over the last few years, have done a lot to sort of get themselves back onto their feet, and which are actually profitable in a very difficult market environment. And a good example of that, and one of sort of the top contributors to our returns over the last year, is Stefanuti stocks. So as you probably know, this is a construction firm, and construction businesses have been through a terrible time over the last few years, or certainly, in fact, since the World Cup. And it's been a very, very competitive market, and many businesses actually sort of don't even exist any longer. Now, Stefanuti is trading on a very low price to earnings ratio, which means that it's very cheap relative to its underlying earnings. It's actually on a PE of around 3, which is extraordinarily low. And it's actually one of the few sort of construction businesses that is profitable at the moment. But you know, there is a very difficult landscape for construction businesses in South Africa. There's no doubt about that. But we believe that if you're paying a 3 PE for a company like Stefanuti, which is actually profitable even in tough times, that if expectations, very sort of low expectations of the macro landscape in South Africa turn out to be correct, then you probably have got that in the price. That's probably one of the reasons why the price is so low relative to the underlying earnings already. However, if Stefanuti, which is probably one of the better positioned construction companies as a result of many others sort of going out of business, if things turn out to be just a bit better than the market is pricing in, then you've got a lot of upside potential with the stock. And already we've seen some of that coming through, where sort of the market has been overly pessimistic, having seen them gone through a very, very difficult time. So that's also a very good example of a stock which is actually just simply not available to a larger manager. And that speaks to sort of our size advantage. One of the great things about being a small value manager is that we have a wide opportunity set to look for value opportunities. At the sort of tail end of a long bull run, value opportunities are few and far between. So you really want as much sort of a landscape to look for those. And if you're a large manager, if you look at the last year, out of the Aussie 40, 31 of the top 40 stocks in the South African equity market were down last year in negative territory. So only 9 stocks posted a positive return. If you're a large manager and you kind of confined to that universe, well then 2018 will have been a really tough year for you. And it's very hard to hide from sort of the pullback in the market if you can only focus on that part of the market. Conversely, we in fact held 5 of the 9 that actually were in positive territory. So we do buy large caps, but crucially only when we feel that they're undervalued. So of the 5 that we held, which were in positive territory, that includes some of the resource stocks such as Anglo American, BHP, Anglo Gold Ashanti, and then the insurer Old Mutual was up, as well as SPAR, which we hold. So in fact, out of the large caps, we actually did very well in identifying those that were undervalued and potentially also provided some downside protection. But in actual fact, 45% of the equities in this fund are in the small and mid cap space. And so, that just goes to show where we're seeing value in South Africa. And I think that is really where the returns are going to come from in this market. It's not going to be in the stocks, which obviously are still, in many cases, sitting on quite high multiples. And that includes many of the retailers even, when it's tough on the ground and the multiples actually don't reflect that. In other words, the prices have not actually come down enough. Even though they've come down significantly, they're not in value territory yet, because they're still sitting, for instance, if you look at something like a ShopRite, it's still sitting at a 20 PE, and they've just sort of come out with results to show that their turnover was basically flat. So these companies are struggling and the multiples aren't reflecting that yet. We'll be very cautious about going into those stocks. However, having said that, quite a lot of the large caps came under pressure, and we've actually taken the opportunity in the last quarter to add some of the names which have been down significantly over the course of the year. And that included British American Tobacco, which we already did have a small exposure to through Raynit, Richemont, the luxury goods company, Woolworths, ABSA, and Aspen, which has also come back significantly, more than 40% during the course of the year. So we've started to introduce small positions to those because we now feel that they are actually in value territory. The portfolio still has quite a bit of cash in it relative to a fully invested equity fund. It's got about 13% in cash. We're quite comfortable with that. We will put that cash to use as more opportunities come our way. But what we really have is a portfolio with many uncorrelated, well-diversified investment ideas where, quite frankly, if things don't turn out as we expect, our portfolio is not going to be derailed. And it is a portfolio that is very different to the market. And so as a result, we believe that this is really the sweet spot for investors right now, value territory, away from sort of the indices, and also sort of going a little bit down into sort of the small and mid-cap opportunities where the price to value ratio makes the most sense.